distinguished guests from the World Bank, and also dear audience and viewers from China and around the world. This is Huiyao Wang. I'm chairing this actually webinar, special webinar event that we're featuring the Global Economic Outlook report that actually done by the World Bank. Now, I'd like to also introduce our next speaker is Dr. Martin Reiser. He's the World Bank country director for China and also Mongolia, and he's also director for Korea. He has taken care of quite a few countries. He's been in China for some time. We see Dr. Martin from time to time here in Beijing, but he was the country director, of course, for this for quite a while, and but he's leading a team that is managing one of the World Bank's largest loan portfolios and directs an extensive analytical and advisory program with China and Mongolia, and also a growing knowledge in partnership with Korea. One of the things impressed me the most is the Dr. Martin. Also, he's very fluent in multiple languages, including German, English, French, Portuguese, Russian, and Spanish. So that's really amazing. And he also published numerously articles in economic journals and in the monographs, several monographs as well. He has a very well academic background. He's a doctorate degree in economics from the University of Kiel in Germany, and also a degree from economic history from London School of Economics and Political Science. So he has worked in many institutions, including of course the European Bank for Reconstruction and Development. He was also country director there then, and also editor of the Transition Report. So Dr. Reiser, you are in China. You know China, and also you're also been in World Bank since 2003. So what's your take of what just Dr. Kose just said, but also your presentation on your view combining China and the world? Dr. Martin Reiser, please.
Well, thank you, Dr. Wang, for that very kind introduction. Unfortunately, I don't speak Dr. Kose's language, even though I spent a few years in Turkey, but it's far too difficult, and I'm afraid Chinese may also be too difficult for me. Ayhan asked 4 questions. I'm just going to ask one question, and that question is, how is China different? And I think it's clear that China's performance, when you look at the data that Ayhan presented, is very different than that of other emerging markets, and indeed is quite different from the rest of the world. If the rest of the world is experiencing, if anything, something like a tick mark or an L-shaped recovery, in the case of China, it's really been very close to a V. So in that sense, it's really quite different. It's also different with respect to investment. Dr. Kose pointed out how the world is seeing investment plunge, and that has potential implications of long-term growth. Whereas in China, investment rates have always been, extraordinarily high, and they haven't really fallen significantly over the full year of 2020. They fell in the first half, and then they recovered very quickly. Dr. Kose also pointed out concerns of a trade, but one of the things that has surprised us is how robust and resilient China's trade performance has been, particularly on the export side. And that's because China had the ability to start up its factories earlier than elsewhere, and it happened to be able to re-engineer its export profile to deliver the kinds of goods that the world was demanding: medical equipment and consumer electronics. And so Chinese export performance, despite of a fairly gloomy global outlook over 2020, has done actually rather well. So in that sense, China is different. Now, in some sense, China is the same. China is the same with respect to debt. China has had a massive increase in debt domestically, and China is a source of financing for some of the increase in debt that we've seen in other parts of the world. China is also very similar with respect to the productivity slowdown that Ayhan described. Productivity declined before the onset of COVID everywhere, but nowhere did it decline faster than in China. And in our innovative China report that came out about 2 years ago, we pointed to the fact that China's growth model that had generated very fast economic growth over several decades was running out of steam, and there was no prospect for the same model generating the similar kind of growth rates. And so you do see also in China a decline in potential growth estimates into the medium term, and the need for reforms to rekindle productivity growth and put growth on a different foundation. Now, how does this picture in China connect with what's going on in the rest of the world? I think there are important connections that have implications for the global outlook because of China's importance in the global economy, but also have implications for policy. The first is that the pattern of China's economic recovery, even though it has done much better than most countries in the world during 2020, has been imbalanced. It's been imbalanced in favor of external versus domestic demand, and you see the emergence of a Chinese current account surplus again after it had virtually disappeared in 2018 and 2019. And that's obviously creating significant strains in the global economy in a context where the rest of the world isn't actually growing. So the current account surplus is not due to other countries growing very fast and sucking in Chinese demand. It's due to China's strong competitiveness, but also to the lagging pattern of China's internal demand versus external demand. Secondly, it's been imbalanced because consumption has recovered less quickly than investment. And so an economy that invests a lot, that increases its supply capacity, but that doesn't generate the domestic demand to absorb that capacity, in a world in which global demand is unlikely to be there, is going to face sustainability concerns over its ability to continue this level of performance. And so clearly the discussion in China in the context of the 14th five-year plan is now around strengthening domestic consumption as a driver of economic growth. And I think that has huge implications for China. I think it's a good thing, but it also has significant implications for the rest of the world, because to the extent that China manages to become an engine for global demand on the consumption side, I think this is good news for Chinese consumers. This is good news for China's trading partners. The second implication is that an investment-driven growth model is very closely associated with a very rapid buildup of debt in China, and a model that generates current account surpluses is closely associated with a rapid accumulation of foreign assets by Chinese banks, and hence is the flip side of the very rapid increase in debt that we've seen in many emerging markets. And so China's ability to shift to a more domestic demand-driven growth model is important in terms of contributing to reducing the global savings glut that is likely to continue in an environment in which global investment demand remains depressed and the global economy is growing less rapidly. So it's really important for China to achieve this rebalancing. In terms of China's internal debt issues, it is clear that 2020 marked a return to a pattern in which economic growth was driven by further accumulation of debt. And that's almost inevitable in the circumstances. But it's also clear that that pattern cannot continue indefinitely, in the sense that already today, the debt to GDP ratio in China is highly elevated. And for every percentage point of increase in economic growth, China currently generates 3 percentage points of GDP increase in the debt to GDP ratio. And so unless China finds a way to grow without the reliance on debt, its debt is going to continue to increase very rapidly as a share of GDP. So the importance of what in China you call the de-risking campaign cannot be overemphasized. And the difficulty of doing that in an environment in which you come out of a period of regulatory forbearance, where regulators have closed at least one eye and maybe an eye and a half over the accumulation of potentially non-performing assets. So the need to do that de-risking at the same time as you prevent the zombification of enterprises that have elevated debt levels without causing instability in the financial sector, I think is going to be a key challenge. So I don't want to speak much longer than that, but I do think that China's performance is different from that of the rest of the world. This is a good thing for China, and it's been a positive thing for China's trading partners. But China's impact on the global economy could be even more positive if it manages to rebalance the source of its economic growth further towards consumption and towards productivity growth, and relies less on investment-driven and debt-fueled economic growth as it has done in the past. And that requires a number of reforms which we have outlined in our December China economic update, which is very closely linked, of course, to the forecasts that Ayhan presented today. The reforms that we have advocated are not new. We have said several of these things before, but we have pointed to the need for China to introduce structural measures that may reduce domestic savings rates, one of the ways in which that can be done, and encourage consumption. One of the ways in which that can be done is to build a stronger social security system to reduce the need for precautionary savings. A second way in which this could be done is to further liberalize labor markets and allow people to move towards to move their households towards places in which productivity is likely to be higher. That would be generate and liberalize the ecosystem. That would generate a significant wealth transfer to the households that would benefit from that. That could also increase consumption and reduce the need for precautionary savings. And perhaps equally importantly, adopt structural reforms by strengthening the quality of the allocation of capital that would generate more productivity growth. And there, I think, to end on a positive note, one of the things that has clearly been demonstrated during the past year in China is the importance of digitalization as a new form of doing business. The pandemic has accelerated this trend, but China has shown itself to be particularly well placed. And so, e-commerce, fintech, and other similar industries have really provided quite a boost to the Chinese economy and provided some continuation to consumption in the course of the pandemic. And so those are trends that could potentially point in the direction of faster productivity going forward. But we've also seen during the crisis significant investment going into old industries. And it's not so obvious that those investments, further infrastructure in the interior, further development of old energy sector, are necessarily going to either generate productivity growth or indeed prepare China well for a future of climate change. And so there's a need, I think, in the allocation of capital to think more about what are the future areas of potential growth, and to do that based more on market principles and allow the private sector to play a larger role in the allocation of capital. So with those remarks, let me stop here, and I really look forward to hear from Dr. Yao Yang, who knows so much more about the Chinese economy than I do, and hopefully can complement my picture, or perhaps.
Great. Thank you, Martin, for your excellent, discussions on Chinese economy, and also the analysis of the situation of all the challenges, opportunities that we're currently facing. I mean, I remember last time when we had this event in June last year. World Bank forecast China last year growth was 1%, something like that, but now it's 2%. So it's actually, we see some positive side from China's economy. Of course, also we hear that Dr. Kose mentioned about digital economy. I think that played a huge role in Chinese pandemic fighting as well, including all the infrastructure facilities that has been connecting China logistically. And for example, China's the transcontinental train to Europe have actually increased during the pandemic, and then the year before. So we see many things actually happen here in China.